But obviously, so it sounds like a great investment, and in Australia we love the property story, that it always keeps growing, it's never going to go down. Tell me about some horror stories that you've seen when it comes to these listed Australian property companies.
Well, when it comes to real estate in Australia, when I tell my family and people that I meet what I do, they immediately ask, oh, so what do you think of the residential market?
Yeah.
Real estate in Australia is somewhat of a hobby.
Yep.
It's a sport.
Yep.
But when it comes to commercial property, it's relatively simpler, but it's not easy. So one of the horror stories, I suppose, that's fresh in everyone's mind is the GFC and the impact that that had on the real estate investment trusts. A number of the REITs, many of which don't exist anymore for a number of reasons, found themselves in this perpetual circle of gearing up, so taking on a lot more debt and taking on a lot more risk. So for an example, I think the average level of debt, or indeed debt for some REITs, would have gone through to the 60% loan to value. Whereas at the moment, the gearing across the A-REIT sector is less than half that, so probably about the 28%. Mind you, that was through the GFC where interest rates were at a much higher level, but they were investing for high growth. Not only that, the debt they were taking on was short-dated.
And that's where you see a lot of these companies start to fall over when their debt levels are too high.
Yeah.
The market takes a bit of a back turn, and they just can't fund the repayments.
Yeah, so they took the view, a lot of the REITs in the GFC, that, I'll take relatively cheaper short duration debt and just roll it over. But it came to a point where that debt market was frozen, not available anymore, so they had to issue equity to recapitalise their balance sheets. But at the moment,
and what that basically means for everyone out there is they ask the investors for more money.
Yes, at a very low price, at a time when a lot of people weren't too confident in how they'd manage.
Yes, they wouldn't reinvest again.
That's right.
Yeah, okay.
Step forward to today, and you've got REIT balance sheets that are in a very, very strong position with less than half the level of debt, but also that debt is long dated, and there's a higher degree of fixed debt as well. So if interest rates go up, the REIT's debt cost is relatively low because they've paid to fix the rate. And of course the debt that they take out could be 5 to 10 years in duration. There's some REITs offshore that take out, accessed 20-year debt facilities at a relatively fixed cost.
Right, so we're talking about some pretty big numbers, some pretty big debt levels, but they're obviously trying to keep the debt down.